Hello and welcome to today's class. Today we're going to talk about accounting equation. Class is going to get a little bit mathematical. So let's get started. What is the accounting equation? Accounting equation basically is assets is equal to equity plus liabilities. Total assets equals total equity or liabilities. Equity is again an internal liability, and liabilities include the external liabilities, as we saw in the previous lecture. Now, this accounting equation, it is the basis for double entry system of accounting. And as per double entry system of accounting, each and every transaction has two effects, two sides, a debit and a credit. By this equation, we are showing the two aspects of every transaction. Whenever there is a transaction, there will be one effect on the asset and another effect on the equity. So how do we compute this accounting equation? First, we will analyze our transaction in terms of identifying the assets, liabilities, revenues, and expenses. Then we will determine the effect of the transaction on the equation. Now, what does this mean? For example, we are purchasing machinery we are purchasing machinery for manufacturing our products. Now the machinery is an asset as it will help us generate more revenue. So how will this be shown in the accounting equation? And under assets, the effect is our assets are increasing, and correspondingly, since we are paying cash to acquire this asset, the cash is also decreasing. Thereby, the assets will still be equal to the liabilities. So, the next step will involve recording this, recording this effect. The next step, after we have determined the effect of the transaction on the equation, will be to record it. Now, before we jump into a problem, I want to discuss certain cases which are very commonly asked in the exam and students sometimes face difficulty with. The first one is drawings. Drawings, as we saw in the last lecture, is any amount of money or the value of goods that the owner withdraws for his personal use. So, how are we going to show this in the accounting equation? So, as per the pro forma, we have assets, liabilities, and equity. The proprietor has invested cash as capital worth 50,000. So, we are going to show 50,000 cash under assets and capital as 50,000 under equity. Now, drawings made worth rupees 10k. So, what effect will this have on the accounting equation? Our cash will reduce by 10,000 because we are removing money, and so will our capital. Then the net effect will be cash is 40,000, capital is 40,000, balanced. The next kind of adjustment is interest on drawings. Interest on drawings, since the owner has withdrawn money from the business can charge the owner interest on that said amount. So, the interest on drawings needs to be paid by the owner, and that will be a gain for the business. So, capital will increase, but the owner has to pay it out of his pocket, which is again from his capital. So, that will be deducted from the capital. So, capital invested as cash 50,000. Drawings made Drawings worth 10k made minus 10,000 from cash minus 10,000 from capital. And you have the net effect 40k 40k. Next, interest on drawings is charged at 5%. So 5% of 10,000 is 500 rupees. We will not touch cash because it is a this is a transaction related to drawings which is linked to the capital. To capital we will add 500 rupees and we will reduce 500 rupees. The net effect will then be cash 40k and capital 40k. So the interest on drawings will be added to the capital as well as deducted from the capital, thereby maintaining total assets being equal to total liabilities. Now our next case is interest on capital. Usually interest on capital is paid to the owner by the business. Interest can be paid on capital, and even on shares companies do give dividends. How will this be treated in the accounting equation? Interest on capital is an expense to the business because we are paying out to the owners. Thus, it will be deducted from the capital. But the same interest, it is like an income to the owner. The owner is getting money, no, is getting interest. The owner's capital will increase. So it will be added back to the capital. So therefore, interest on capital at 6% for rupees 50,000. First we will deduct 3,000, then we will add 3,000 back to the capital, with the net effect being cash 50,000, capital 50,000. Total assets equals total liabilities. Now, the next case is prepaid expenses. Prepaid expenses are those expenses that we have paid in advance. For example, I have taken a flat on lease to run my business, and every month I have to pay certain rent. Now, this month I have little extra cash with me, and I may not have those funds in the next coming months. So I decide to pay off 3 months rent now itself, so that in future I won't have to pay. So that 3 months rent in advance is nothing but my prepaid expense. This prepaid expense in accounting equation will be deducted from the cash, and a new head will be created called prepaid expense, under which this amount will be added. Let's see. Capital invested as cash 50,000, capital 50,000. Now prepaid rent 5,000 rupees. 10, okay, I made an error here. It should be 10,000. I have written only 5. Okay. So cash is 50,000, from which we are paying out rent worth 10,000. Then then we create a new column saying prepaid rent. Then we create a new column called prepaid rent, under which we add rupees 10,000. Liability is nil, capital 50,000. What is the net effect? Our cash is now only 40,000 and the prepaid rent is 10,000. And resultant capital being 50,000. Total assets equals total liabilities. Prepaid expenses are in nature assets. We will be explaining this in the upcoming lecture, so don't worry. Now, the next kind of adjustment is outstanding expense. Outstanding expenses are any of those expenses that are yet to be paid. For instance, electricity bill. We have not paid. The business is delayed making payments for its electricity bill for the last 2 months. So that amount is called an outstanding expense. And in the accounting equation, it will be shown as in the accounting equation, it will be added to liabilities and reduced from capital. Outstanding expense is a liability because we are still yet to pay. We haven't yet paid this amount, so we will not deduct anything from cash. But in liabilities, we will create a new head called outstanding salary, under which we will add rupees 10,000. And in our equity, under capital head, we will deduct this 10,000. So what will the net effect be? Cash 50,000, outstanding salary 10,000, capital 40,000. Owner's equity, which is the capital, will reduce because in future this amount has to be paid, and it will be paid by cash. And whenever an expense is paid by cash, the corresponding effect is that even equity reduces. So that is why now we are removing 10,000 from capital. The next concept is accrued income. What is accrued income? It is income that you have earned but not yet received. For example, you have done a project, you have acted in a film for which you have to be paid 50,000. Shooting is over, everything is done. You are yet to receive your check. So in your books, that compensation will be shown as accrued income. It is income that you have earned but not yet received. How will this be shown in the accounting equation? It will be added to assets, added to the capital. Why added to the capital? Eventually, when you receive the cash, your capital will also increase because your capital comprises of cash. Let's see. Capital, we have 50,000, cash 50,000. Accrued income worth rupees 10,000. So we already have cash 50,000. And since we haven't received money, we will not add anything to cash. But we will create a new column, accrued income, to which we will add rupees 10,000. We don't have any liability arising in this case. And also to capital, we will add rupees 10,000. So what is the net effect? Our cash is 50,000, accrued income is 10,000, and our capital is 60,000. Balanced. Total assets equals total liabilities. Now, the next case is income which has been received in advance. The business hasn't earned this income, but it has received it in advance. For example, we have a customer who has placed an order in advance. He has paid us the money in advance, telling us to deliver goods to him a month later. However, he has paid in full. So, that paid in full amount, we have received cash, okay, but we have not yet sent out the goods. So, we haven't really earned that money. Once we deliver the goods to the customer, then we can say that we have earned that good. But in this case, he has sent us money in advance. So, how do we show that in the accounting equation? We will add it to our assets because we are receiving cash, our cash balance will increase. But we will also create a liability. There is always a chance that the customer might cancel his order and ask us to return the money. So, until we have completed the sale, until we have earned that money, we cannot consider it as our own. Thus, we will make a liability. So, in this, let's see, capital invested as cash 50,000, 50,000. Income received in advance is worth rupees 5,000. So we will add it to our cash 5,000 rupees, and under liabilities we will create a new head, income received in advance. Write that in the liability, and write that in the liabilities column. Equity will remain unchanged. So what would the net effect be? Cash 55,000, income received in advance 5,000, capital 50,000. Okay, so these are some common cases. Now we will solve a problem. Okay, let's do this. Before we go into our books and start writing down the accounting equation in all the formula and format, let us first understand what each particular transaction, what effect each particular transaction has on the assets and liabilities. So assets must equal equity and liability. Assets equals to equity plus liabilities. So in number 1, Anil has commenced business with cash rupees 50,000. So our cash is going to increase by 50,000, and so will our capital. In case number 2, purchased goods for cash rupees 20,000 and credit worth rupees 30,000. So the total amount of goods that he has purchased is worth 30,000, and he has paid cash only 20,000 and credit 10,000. So out of this 30,000, 20k he has paid in cash and 10k in credit. So what this means is our cash balance will reduce and a new asset, that is stock, will increase, and also under liabilities our creditors will increase. That is the effect. The next transaction is sold goods for cash rupees 40,000 costing rupees 30,000. So what would this mean? Goods selling price 40k and our cost is 30,000, 30k. So that means we have made a profit of 10,000. Profit 10k, rupees 10,000. So what effect would this have on our accounting equation? First of all, cash. Our cash will increase by 40k, and our stock, since we have sold all our goods, that will go down, and our capital will increase by the profit worth rupees 10k. Got it? Cash will increase, our stock will reduce, and our capital will increase. Okay, now the fourth transaction. Under this, what is it saying? Rent has been paid worth rupees 500. So it is an expense. Our cash will reduce, and so will our capital. Next one is Rent outstanding. Now, this is an outstanding expense. So, what do we do when we have an outstanding expense? A liability is created. A liability, that is our outstanding rent, will increase and our capital will decrease by rupees 500. Now, number 6. We have purchased furniture on credit. So, furniture is an asset. Asset will increase. But we have bought it on credit and we haven't paid cash. So we owe money to the person who has, to the company that has sold us furniture. So we will have a liability. Our liability will also increase. Next is, we have bought refrigerator for personal use worth rupees 5,000. This basically means a drawing because this fridge has been purchased from company funds worth rupees 5,000. It is a drawing. It will be considered as drawings. So assets will reduce because our cash is, we have spent cash, and our capital will also reduce because it is a drawing. Next, we have purchased a computer for cash. Now we have acquired a new asset. So asset cash will reduce and asset computer will increase. Then the next case is cash withdrawn for personal use. Again, this is also drawings only. So cash will reduce and so will capital. Then number 10, interest on drawings charged at 5% worth rupees 10,000. Okay, so only on rupees 10,000 they are charging 5%. The company is charging 5% from the owner. So interest on drawings we'll have to compute. Interest on drawings is 5% of 10k, which is 500 rupees. So how would this impact our accounting equation? Our capital will increase by 500 because it is an interest on drawings which will be treated as an income to the company, and at the same time it will be reduced because from the owner's point of view it is an expense and thus his capital will also reduce. Now that we have seen what effects each particular transaction will have on assets, liabilities and equity, let's go and record it in the accounting equation. So transaction number 1, you have commenced business with cash. So what would this head be? Cash. Okay. Cash rupees 50,000 and equity rupees 50,000. Okay. This will be nil. 50,000, 50,000. Now transaction number 2. You have purchased goods for cash rupees 20,000 and credit. You have purchased goods for 30,000 and you paid cash worth 20. Okay. So our opening balance of cash is 50,000. Now we have stock. Now we have stock worth. So first we are going to do minus 20. We will first record minus 20,000 because that is the amount of cash being paid. And to stock we will add 30,000. And to stock we will add 30,000. Since we have purchased on credit, we will have a creditor. So to the creditor, we owe rupees 10,000 and equity will remain untouched. So what would this result in? 10,000 plus, sheets doesn't allow me to just do that. Okay, fine. 10,000, 50,000. And here I have 30,000 balance, 30,000 balance. So it is tallying 60,000 on my asset side and 60,000 on my liabilities and equity side. Okay, third transaction is sold goods for cash rupees 40,000 costing 30. Now the opening balance of cash is 30,000 and we are getting an additional 40,000. So I'm just going to write add because I can't do the plus sign here. Add, okay, add 40,000. We are receiving 40,000. Now stock, we have sold entire stock. So minus 30,000. This will be equal to 70,000 cash and stock will be 0. And as we saw in the effects, we have a profit of, and as we saw in the effects, we have a profit of 10,000. So the 10,000 profit will be added to our capital. Here 10,000, here 50,000. Just write A, add 10,000. So which gives me a total of 10,000. And here 60,000. 70,000, 70,000. Balanced. Okay. Now the fourth transaction. Rent paid. Now rent is an expense. So our cash will reduce and so will our capital. 70,000 minus 500. 10,000. Okay, yeah, this will be here. And 60,000 minus 500. So this will be 55,500. 10,000. Nothing here. And 65,500. Balanced. Equation 5. I'm sorry, transaction 5. I don't know why I said equation. Rent is outstanding. So this is a creation of a liability. Cash, nothing will happen to our cash. Our cash balance will remain the same. But under liabilities, a new liability will be created called outstanding rent. Outstanding rent to the extent of how much? Rupees 100. Okay, outstanding rent rupees 100. So I have 10,000 here. And to equity, I will add rupees 100. And subtract rupees 100 because my capital will decrease and my liabilities increase. So the net effect is still 65,500 on both sides. And assets are equal to liabilities. Yeah, I'll just give you the total so you don't get confused. 1,000, 100, 55,400. And here is 65,500. Okay. So transaction 6. Now you have bought furniture on credit for rupees 5,000. So furniture is an asset to the company. We will create a new asset. 65,500 cash. We have purchased this furniture on credit, right? So our liability to so under furniture column we will add 5,000, and to our liabilities, to under liabilities creditors we will add another 5,000. This will be 100. 55,400. So the totals 55,400, 100, okay, 100 and 15,000. Total here is 5,000, 65,500. Okay, so this will become 70,500 And this will also be equal to 70,500. Just sum of these three. 70,500. 70,500. Okay, and this is just for my checking. We don't actually need to write that in the exam. Next transaction is purchase of a refrigerator for personal use. So this basically is a drawing, and our cash balance will reduce by 5,000. Yes, 5,000. This is gonna be like that. 5,000, 15,000, 100, 5,400 minus 5,000. So 50,400, 100 under outstanding rent, 15,000 here, and we have 60,500. Both are, oh yeah, and of course, for under furniture also 5,000. Both are balanced. Next transaction, number 8. You have purchased computer for cash. Okay, so we have purchased computer for cash. That means it is an asset. This means it is an asset to the company. Computer. We will create a new column called computer. You have purchased cash for compute. You have purchased computer for cash worth rupees 5,000. So our cash balance will reduce by 5,000. Stock is anyway nil. Furniture is worth. We have furniture worth 5,000, and now we'll also have a computer. We'll have a computer worth 5,000. Creditors will still remain 15,000. Outstanding rent 100. And from our equity and under capital, we'll have 50,400. So 15,000, 100, 50,400. And under equity, we will have 55,500, 5,000, 5,000. Okay. Now, the next transaction is cash withdrawn for personal use, drawings. 55,500 minus 10,000 drawings. Cash is reducing, right? And rest everything will remain the same. 1,000, 5,000. Yeah. Just copy that and paste it here. Minus 10,000. Even our capital will reduce. 40,400. 100, 15,000. 45,500. Our cash balance will be 45,500. We anyway don't have stock. 5,000 furniture and 5,000 computer. So 55,500, 55,500 on both sides. Our total assets equal our total liabilities. Now this next, the last transaction is interest on drawings charged at 5%. Interest on drawings. So our drawings are rupees 10,000. On 10,000 rupees, how much is 5%? 500 rupees, right? And we know that interest on drawings is just a capital transaction, so our assets will not be affected, nor will our liabilities, but only our capital will get affected. So 40,400 plus 500. Okay, I can't do that. Add 500 and minus 500. So the net effect will be 40,400. 45,500 on my cash balance. I don't have a stock balance. 5,000 furniture, 5,000 computer. My creditors are worth 15,000 and my outstanding rent is 100. Now, the next part of this question, they are asking us to create a balance sheet. Okay. So how do we create a balance sheet? Usually, a balance sheet is mostly created in this format where is a balance sheet is nothing but, so you have assets on your left side and liabilities on your right. And in this statement, you will show a list of all the balances. Okay. So here we have what all balances do we have? Okay, this is cash. I don't know why it got removed. So cash worth 45,500. So we'll write cash 45,500. Furniture, okay, stock is nil. Furniture worth 5,000. And furniture, and then what was the other one? Computer. We purchased a computer worth 5,000. Okay. And this total is, okay, you won't write the total yet. Now, under liabilities, we have creditors, outstanding rent, and our equity. So usually for a balance sheet, the pro forma, you have to follow pro formas because it's very easy marks. The pro forma for balance sheet as on, I think they haven't mentioned any date, right? Yeah, they haven't mentioned any date, so no need to write anything here. As on so and so date in the books of Anil. Book of Anil. So under liability, we have creditors worth rupees 15,000, and we have outstanding rent, outstanding worth rupees 100, and our capital 40,400. Yeah, 40,400. So if I round that up, how much would it be? 15,000 plus 100 plus 40,400. That gives me 55,500. Oh yeah, 55,000. That gives me 55,500. And on my assets side, again, 55,500. So here my assets equal my liabilities. And this is the sum of accounting equation. Usually in the exam, they will give you such a list of transactions and then they will ask you to prepare a pro forma, uh, ask you to compute the accounting equation. So you just follow this as as and when your assets keep adding, make another column for your assets and similarly for your liabilities. And then in the end, all these balances that you will get, the final figure over here, these you just take and add it into your balance sheet. This is all for today's lecture. So remember, total assets equals total equity and assets equals equity plus liabilities. I hope you understood today's class, and that's all for today.